Hello and welcome to this brand new episode of Smart Money. Today we speak about women and financial independence. Now, did you know that out of every 5 investors in India, only 1 is a woman? But why do we insist that women manage their own finances and invest wisely? Here's why. Did you know that India ranks 140th amongst 156 countries in the World Economic Forum's Global Gender Gap Report as of 2021? As per this report, women's estimated earned income in India is only 1/5 of men's, which puts the country amongst the bottom 10 globally on this indicator. Now, this implies that women earn significantly less than for the same earning years as men. So they need to save and invest a lot more to ensure that they meet their long-term needs. And here we are here to discuss just that. Our expert today is Devina Mehra, the founder, chairperson and managing director at First Global. Devina, thank you so much for joining us. You know, this is a cause very close to my heart because during the pandemic, I realized and I got a lot of feedback from investors that they earn money, women investors, they earn money, but they just don't have any grip or any handle on where their money goes. It's either managed by their husbands or their fathers or their significant others. So I want to start by asking you, why is it important for women to take charge of their finances, especially in a challenging world like today?
Hi, Sonia. Good to be back with you. And it's a cause very close to my heart as well. And, the one-line answer to why you need to take charge is that you can never be free or independent unless you have financial independence. That is a necessary, probably not a sufficient condition, but without that, you can be nowhere. And as you said, in India, the gap is very wide. And this really came home to me when a friend lost her husband a few years ago, and I found that she was totally clueless about the financial side of the family. Even to the extent of not knowing the bank accounts or the investments or whether her husband's business was a proprietorship or a company. This is a postgraduate. This is not like some illiterate woman in a village. And then I started asking around, and I have a number of friends who are doing very well professionally with a corporate professional, civil servant, scientists, etc. But barring a couple of exceptions, most of them were not managing their own money. As you said, most of the time it is managed by some male member of the household, the spouse or the father or something like that. And if you have the time, I'd like to also go into why I think this happens. What are the major reasons why the women don't take charge of their own finances?
We get asked a lot about these women, right, who earn money but don't know where to start. So we are here to educate our viewer. It may be a woman, it may be a man for that matter, as to how do you start in a world like today where there is an overload of information. What are the resources that I need to look at to educate myself financially?
In fact, where this question also arises, especially for women, is that a lot of women don't invest thinking, I don't know enough. My husband knows, or whoever, my father knows or my brother knows, but I don't know enough. So first of all, I want to say that confidence does not equal competence. Write it in bold letters in front of you because men are more confident about investing, but data actually shows that women do better. So that is one thing to remember. The other thing, before going to the educational resources, one other point I want to make is that many women don't get into managing finances because they have so much on their plate. They are working professionally, they're looking after the household, the kids, the in-laws, the parents. And this is one thing the husband is willing to look after. So they just think that this is one thing off my plate, but that's the wrong way to look at it. In terms of educational resources, I mean, you could not be in a better place today. When let's say I was starting out, it was far more difficult to access resources. Now they're all over, books, articles, or if you want to consume educational content in another form, there are podcasts, there are videos. So whatever suits you in terms of your learning style, you can learn anything. There are online courses by universities even. So if you think you don't know the basics of finance or accounting or basics of security analysis, there are like lots of resources that in the matter of a few weekends you can know the basics very well, and probably better than the men in your family, I can tell you.
Okay. Well, I mean, gender agnostic, if you look at it, people are generally nowadays risk averse, right? And women are even more risk averse because traditionally women sort of save their money in the form of jewelry. They don't really get into the more risky assets. Forget about equities. I mean, today there's so many more risky assets that one can look at. But if you had to advise a woman who's watching you right now, how do I stay in the middle of the risk spectrum? What is the best way to grow my portfolio but not be too risky as well? What would your answer be?
Okay, so I mean, this of course advises both for men and women, because the investment portfolio doesn't care about the gender of the owner. But women often are good at savings and not that oriented towards investment. I mean, as a generalization, of course, I'm talking only averages, but that really over a period of time can really put you behind. Let's say you are saving ₹1,00,000 a year. And you put it in a savings account at 5.5% or even in a fixed deposit, at the end of 30 years, you will have 77 lakhs. If you put it in a multi-asset kind of portfolio, let's say compounding at 9.5%, you will have double that amount, 1.6 crores. If you put it in an equity kind of investment, and even without assuming any great 20% return, even if you're talking 12-13% return, you are talking about 3 crores at the end of 30 years. So this is something you cannot say that I won't look at. So you will have to look at some assets beyond the absolutely risk-free bank fixed deposit kind of assets. So that is the first step to take. And risk, of course, means that there is risk of a loss also. So periodically, at some point, your portfolio, you will have a loss. So again, be prepared for that. That, as in software, they say it's a feature, not a bug. That this is something that comes with the territory. That if you're investing in equity markets or through equity mutual funds also, which is the same thing really in a sense, you will see the downside. So I don't know how much to allocate to each asset. That depends on what your goals are. How many years do you have left to retirement? When do you need the money? At least the foreseen part, the children's education, your retirement, whatever it is. So it comes out of that. But don't be on either end of the risk spectrum, because like last year, I was warning on many of these Twitter spaces and so on that people have gone from fixed deposit straight to crypto trading without even being equity investors. So don't be on extreme ends of the risk spectrum, or even derivatives trading or equity trading. Be in the middle, because you have other things to do in life, and this is part of your life, not your entire professional life. So think very carefully, objectively, and accordingly allocate your assets.
So be in the middle of the risk spectrum, right? Don't need to go at extremes. That point is taken. But you spoke about the investment in bank FDs versus equities. And if I can, my director can just pull that plate up on the comparison between investing in a bank FD. Okay, here it is. So this is a 1 lakh per year investment, right? If you invest $1 lakh a year for 30 years. Now we have the plate on the screen. If you invest in banks, you at 5.5% per annum, you're barely making 77 lakhs. This is over 30 years. A multi-asset portfolio will give you 1.65 crores at 9.5% per annum, and an equity portfolio will give you 3 crores. So at the end of 30 years, you will comfortably have 3 crores in your portfolio at 12% per annum. And this, I guess, you're taking 12% as a very conservative, return profile, right? So tell us a little bit about that, Devina. Go ahead. Yeah.
So actual return on the Sensex has been from over a little over 40 years. It has compounded at about 15.5%. But there have been very big variations. So, the first decade you compounded at 21%, next decade at 14, then 17, then 8%. So there are, as I said, equity, there are even on a decade basis, there are big variations, and almost every year you will see a big change from the peak to the trough. You will see declines. It is not a steady thing. So therefore, The predictability in equity for 2, 3, 4 years is low, but when you are talking decades, yes, there is some predictability.
Okay, so now just, for the benefit of our viewer who perhaps has not started, or that woman who has not started investing yet, you talk about a multi-asset portfolio and an equity portfolio. What is the difference? And for someone who's just getting started, what should one look at?
Okay, see, first thing to remember is that don't get too bogged down that I don't know every single security. In parties, people are talking of something that I bought at 50 rupees has now become 400 rupees and all that. How will I ever catch up with that? First thing to remember is that most of your returns, as in 85 to 90% of your returns, come from asset allocation, not from security selection. So what does that mean? So you first look at different categories of assets. So there is fixed income, which includes bank fixed deposits, which is the lowest risk. Then you also have fixed income mutual funds and things like that. Then you have equity, which is both equity mutual funds as well as PMS schemes, direct equity, all of that is equity. There is real estate, there is gold. Then you have other assets like crypto, or people who are active in the markets even have derivatives and commodity exposures. So that is the gamut, and this is, I'm talking only India. Then you have to look at geographically also whether to diversify. I mean, my recommendation is to diversify, because now you can send money overseas to invest, and that is important. I was looking at, for example, when I started my career in the mid 80s, the dollar was 12 rupees. Now it is 80 rupees. So you have seen an 85% decline in the course of a career. So I mean, if you are just starting out in life, it is not prudent in many senses to have your money only in one country, what we call SCARs. So don't have everything in a single currency, a single country, single asset, which is, let's say, Indian equity. So have a diversified portfolio. And this again, which is the same for men and women. So decide on something, but don't also put everything in equity, because as I said, the predictability in the shorter term in equity is not so high. So you might need a money to put a down payment for a house, or you might lose a job, or you might decide to study further, or there might be a medical emergency. So you might need some cash. So that is why you need to be in different assets. And also, as I said, it depends on how much you put in each asset, depends on how long it is before you will actually need the money.
Okay, well, let's do one thing. Let's take this discussion forward, but we need to slip into a short break. Don't go anywhere. When we come back, we'll continue talking about asset allocation, about how you should be investing, and if you're a woman, why it's important to invest systematically to grow your wealth. We'll come back in just a bit. You're still watching Smart Money on CNBC TV18. We are in conversation with Devina Mehra of First Global. We're talking particularly about women and financial independence. As we told you earlier, not too many women, at least only 1 out of 5 people in India is a woman investor. So we're trying to sort of bring about some financial literacy to help women invest better and to grow their own wealth. Devina, I wanted to ask you about the rules of asset allocation that one must follow and what all should one avoid. We generally know what one should invest into, but what should one avoid?
So if you're not a full-time investor, avoid things like on the risky end of the spectrum, whether last year I was warning against crypto. Now I think anyway people would have gone out of that, or too much exposure to things like derivatives or commodities. As I said, all these things at the most can be a tadka to your dal. They cannot be your dal. So if you're a normal person having a life other than investing, then just concentrate on getting the broad asset allocation right for your goals and how old you are and so on. And rather than trying to refine it too much and trying to get the last bit of extra return. And also, let me tell you that, people talk very grandly about the great picks and the multi-baggers they have found. They will never, ever say that where all they have lost money. And the greatest investors also never have a portfolio which consists of all multi-baggers. So,
That's true. That's true. I
whether
agree.
it is Warren Buffett.
But you know, I mean, also then you help us. I mean, you help us build a multi-asset portfolio, right? As you said, it's better to just be a bit cautious and not sort of go in for, forget about crypto, even go in for the small cap stocks or the multi-baggers. There's no point looking for that. Be consistent, you know, with your SIPs, etc. But if you want at least, say, 15% compounding growth over the next 20 years, since women do have a lot of financial responsibilities, whether it's educating a child, getting them married, you know, or even you're having your own retirement plans. If I want a 15% compounded growth, what kind of assets should I have in my portfolio?
See, 15%, even in theory, you will not get without a pure equity kind of portfolio. No, in a blended portfolio, 15% you might get. I'm not saying you will not get. You in the last 2 years you have, but I'm saying on a consistent basis, that is not what that's not what history says. If you take history as a guide, so if you are taking a blended portfolio, 10, 11, maybe that is about the maximum you can target. You might get more, as I said, but you cannot bet on it. And also, I mean, I want to underline that again, that be prepared for drawdown, be prepared for losses in the middle. You know, if you're going to panic and get out every time the market falls and try to get in when it's running up, that's absolutely the wrong strategy. It is like last year when NASDAQ was running up, everybody wanted to jump onto NASDAQ ETFs and NASDAQ fund. After it crashed 40%, suddenly people said this is too risky and I must get out. So you get in and out at the wrong times, which is to be avoided. And as I said, do globally diversify. That is very important. And this is a learning that came to me through, let's say, 25 years ago. There was an Asian crisis, which, you know, many of your viewers may be too young to remember, when not down and out countries, but Asian tigers, which is Taiwan, South Korea, Thailand, Indonesia, all of them fell 50 to 90% in dollar terms, so in 1 year. So that actually was the wake-up call for me personally, that it is not prudent to have all your eggs in one country basket. However,
since
you think of that country.
You know, since you are sharing a lot of your personal experience, it will help our viewers to understand from you, what was your first experience of achieving financial independence? And what was that turning point when you decided, you know what, I'm going to take my salary into my own hands and not let my father, my brother, my husband take decisions for me? How early on was it?
Well, my father had no clue about investments anyway, so he was never involved in managing his own or my investments. I mean, my parents never even asked me what my salary was. I don't think they had very good idea of what their own salaries were.
I think that's good, right, in a way? I mean, it's good. You learned it the hard way. You didn't have anyone to sort of handhold you.
Yeah, I mean, when I came to do my MBA, I didn't even know what a share was or what a debenture was. I had absolutely no clue, because Lucknow wasn't a business city. It wasn't an investing city. So in the beginning, of course, it was all usual, that whatever is in the bank plus PPF and things like that. It is only slowly that you really started concentrating on this. And as I said, as a woman, there is always this temptation and that there are already too many things on my plate, so let somebody else handle that. Of course, now it is easy for me because I have a team managing portfolios and funds, and they can just as well do it for me as well. So,
but you created that team yourself, right? So kudos to you for that.
Yes, I mean, they've been all trained by me. So I mean, I've been in the business, so you know it has been relatively easy for me. But as I said, this is something that you have to consciously do, because otherwise, a lot of professional women also just, you know, they are not even taking a decision that I will not manage my own money. It is just a drift kind of thing, that it just happens to move to the man, and it just goes on like that, and you keep meaning to look at it, and then you don't look at it. So it just drifts along.
Yeah, finance, so I guess, traditionally, I guess finance has been sort of a man's world, but now things are changing. Recently, you know, a very young investor approached me and asked me, she was just out of college, and she asked me, I always second guess myself. I don't know if I should pick this stock or not. So, somehow it comes easier to my husband than it does to me. Why is that, you think? Why are women so reluctant to take those financial decisions? And how do you change that? I mean, what are the personality traits that perhaps you need to harness in order to change that?
Okay, first of all, as I said earlier, that imprint it on your mind, and this holds for everything in life, not just investing. That confidence does not equal competence. I learned it through hiring mistakes, but this is so important, that just because the man in your life says or is or acts confident doesn't mean that they're actually good at managing the money. So get over that mental barrier. The second mental barrier, which Indian women in particular find it difficult, is that there will be losses, as I said, that especially if you are investing in equities at some stage. So at that time, both the woman and her spouse, in a typical situation, the woman will also beat herself up saying that, why did I do this? And the man will also say that, if you didn't know this, why did you have to dabble in it?
Yes.
And so you will step back. Whereas if a man makes a loss, it is all fine. I mean, most women are even reluctant to question their husband in the interest of quote unquote peace in the household, that why did they make losses? But the husband has no such barrier. So there's a lot of socialization that has gone behind it, which you have to overcome.
I agree with you, and I guess that's a debate for another day and another show, right? So let's wrap up. We have a couple of minutes left. I wanted to ask you, since you are a symbol of financial independence, you've been managing your own money, you've been growing other people's portfolios as well. What has been your best and worst financial decision through the course of your career over the last decades?
Over the last decade is a little bit more difficult, but I probably got into equity investing a little later than I should have. Of course, it still was not so late by general standards, because I started working at 21. So, even if I didn't do it for the first 4 or 5 years, it was not such a big gap. But yes, I probably should have focused on it earlier than I did.
And your best decision?
Best decision probably to get into this business in the first place, and into the world of investment, which besides the money part also is very rich in learning.
Oh, absolutely. And I can tell you, as a market commentator and observer, there's so much to learn every single day, and it's equally challenging, right? But there's no fun without it. Once the passion kicks in.
Very few businesses where you can say that 3.5 decades on that you're still learning.
Absolutely, absolutely. Devina, it's a pleasure speaking with you. We've run out of time, but not out of questions. Thank you so much. And I really enjoyed this conversation, because it's more about, educating the investor that it's never too late to start your financial journey. All you need is a bit of confidence, a lot of research, and just faith in yourself, right? Thanks a lot, Devina, for these pearls of wisdom.
Thanks, Sonia. Great being on the show. And I hope a lot more women become financially independent.
Oh, absolutely. And I'm sure we've done our own bit, right, to make sure that financial literacy spreads throughout, especially with the women folk. Thanks a lot. With that, it's a wrap on this edition, the special edition of Smart Money. Thanks a lot for watching. Have a great weekend.